Realty Income is on a 5-year downtrend with a price return of negative 31%. Meanwhile, their fundamentals have grown consistently over the same time frame. Better yet, O offers a current dividend yield of 5.5%, which is near a 10-year high. But does the high yield indicate fundamental risks? Or is the market mispricing Realty Income? Today's video will be an in-depth analysis of Realty Income stock, covering business operations, fundamental, and tactical analysis. Realty Income owns real estate which it leases to its clients through a process which is especially beneficial to the property owner, known as a net lease, which requires the client to be responsible for monthly rent and certain property expenses, including property taxes, insurance, and maintenance. Meaning many of the downsides of property ownership are transferred to the tenant. Realty Income operates in every U.S. state and a few foreign countries, including the UK, France, Germany, Ireland, Italy, Portugal, and Spain, although their international segment only contributes 15.8% of their total rent collection, so they are predominantly a U.S. real estate company. They break down their property types in a few ways, one of which is by top 10 industries, and they are well diversified across these industries, with their top property type being grocery at 11.4% of rent, convenience at 10.2% of rent, dollar stores at 7.1% of rent, and so on. Another way they more broadly categorize their properties is by retail, industrial, gaming, and other, with their largest segment by far being retail at 82% of total rent, followed by industrial at 12.7% of rent, gaming at 3.9% of rent, and lastly, other at just 1.6% of rent. Retail being their largest segment is something I see as a substantial benefit to shareholders for reasons I'll cover later in this video. One of the most important aspects of evaluating real estate investment trusts, or REITs, is determining what proportion of their properties are actively being rented or leased, which is called portfolio occupancy. They have a current portfolio occupancy level of 98.6%, leaving only 1.4% of their total portfolio as either up for sale or lease, which gives credit to their property acquisition strategy and their tenant selection process. But as a stress test, I think it's important to look at occupancy rates when they're at their worst. For Realty Income, their lowest occupancy rating over the past 32 years was in fiscal year 2010, when their occupancy rate hit a low of 96.6%, which is still quite high and proves that Realty Income's portfolio has been resilient even during challenging economic cycles. Another important element of real estate investment trusts that I look for is that the underlying portfolio of properties is growing over time, so that the company is growing not only by increasing rent, but also by acquiring more properties. As of their most recent annual report, Realty Income holds 13,458 properties in their portfolio, which is a 132% increase from their property count 5 years ago, which was just 5,797 properties. So their portfolio base is growing substantially over time, which will lead to more total rent collected as the portfolio grows. Now let's cover the macro level pros of Realty Income's business. One of the major advantages to their business is that they own land, which is the backbone of an economy, because almost every business needs some physical establishment in order to conduct their operations, and available land is ever dwindling in abundance. Another huge benefit to their business is that they are well diversified by geography, operating in every U.S. state, and only one state represents a disproportionate amount of their total rental revenue, which is Texas at 9.6%. Although this makes sense because Texas represents 9.2% of the total U.S. population. Otherwise, Realty Income has a relatively small footprint in Europe, but the representation there is growing rapidly in recent years, considering they made their first acquisition in Europe in just 2019. And Europe now represents 15.8% of Realty Income's rental revenue. Not only are they diversified by geography, but they are also diversified by business segment, spanning across all of these different categories, with their largest segment being grocery, which is arguably the most stable property segment due to its essential nature. Another way they categorize their property is by retail, industrial, gaming, and other, with their retail segment representing 82% of their total rent. And their retail properties primarily operate in suburban and urban areas, which is beneficial since urbanization is continuing to trend up in the United States, while their smaller segment, industrial, makes up 12.7% of rent. I see the industrial segment as being riskier than retail due to the fact that many industrial REITs cut their dividends during economic downturns, like Prologis, for example, which is the largest industrial REIT, and they dramatically cut their dividend in 2009. and their dividend has yet to recover to this day. So this segment being small is an advantage for Realty Income and should provide more stable rent collection during economic downturns. Additionally, Realty Income holds some office properties within the category titled Other, but the office properties within Other represent less than 1% of the total rent collected. And office properties are some of the least desirable assets in my opinion due to their shrinking necessity. So Realty Income having minimal exposure to offices is another advantage to their portfolio stability and rent collection. Realty Income is proving to be a solid business, but there are some risks to consider. The first is interest rates being relatively high compared to the last 10 years, with the current federal funds rate being at 4.3%, which impacts the lending rate for other borrowing transactions, like mortgages and business loans. This is a headwind for Realty Income in two ways. One is that high interest rates lead to economic contraction, since economies run on borrowed money. And with higher interest rates, the borrowed money becomes more costly and less advantageous in cultivating business growth, which in turn can lead to struggle for businesses that Realty Income rents to, like Walgreens, for example, which makes up 3.8% of Realty's total rent. And Walgreens currently has $67 billion in debt, while their net income has been negative for the past 2 years. And worse yet for Walgreens, their borrowed money is even more costly due to the high interest rates. So Realty Income could lose Walgreens as a tenant, but even if they do, they can still rent out those properties to a more financially sound tenant. Or Walgreens may close their less popular stores and hold on to their more popular stores in the meantime. Another substantial impact of rising interest rates on Realty Income's business is that they carry a meaningful amount of debt, and they continue to issue debt in order to buy new properties, which is typically how real estate investment trusts purchase properties. That is, by using debt or by issuing shares. So the debt that Realty Income is using to purchase new properties is also becoming more expensive and offers less potential reward. They currently have a total debt level of $24.7 billion, while their latest annual AFFO, which is a proxy to free cash flow, came in at $2.8 billion, which is a debt to annual AFFO of 8.9 times. Another broad risk of investing in Realty Income is that it's a REIT, and the typical way that REITs create capital to buy properties is by issuing shares, which dilutes existing shareholder value. And if a REIT is unable to use the capital from share issuance effectively, this can lead to a reduction in individual share value over time, which is why it's especially important to look at fundamental metrics for REITs on a per-share basis to get a true sense of company value per share, rather than from a whole number. For example, if we look at Realty's revenue on a non-per-share basis, you might think they're growing rapidly, but they're also issuing a substantial amount of shares, so their revenue growth on a per-share basis is substantially slower. The last macro-level risk to commercial real estate is the rise of e-commerce, which is driving consumers to shop online rather than at physical businesses, which most of Realty Income's rent collection relies upon. Although the physical store companies don't have to thrive in order to stay in business. They just have to maintain their physical store presence and remain profitable for Realty Income to continue collecting rent. And not all of the businesses Realty Income rents to will be dramatically affected by the rise of e-commerce. Actually, many of the industries that they rent to will probably be minimally affected by e-commerce growth, like grocery stores, convenience stores, and home improvement stores, to name a few large categories in Realty Income's portfolio. Now let's get into the foundation of the business, starting with revenue on a per-share basis. Realty Income's revenue has grown slowly but consistently almost every single year over the past decade, except for a nominal decrease in 2016, giving them a 10-year compound annual growth rate of 3.8%, which isn't stellar, especially considering the recent rate of inflation. But you probably know this isn't a growth stock, but rather an income opportunity. And a more important metric is AFFO, or adjusted funds from operation, on a per-share basis, which is comparable to free cash flow and shows a more glamorous picture than revenue, with a 10-year CAGR of 4.5%. And AFFO has grown every year over this period. Next, we see shares outstanding. And like I referenced before, Realty Income has diluted shareholders significantly by a 10-year CAGR of 12.2%. But this also shows that despite their share dilution, they are able to allocate their capital effectively, since their AFFO per share is still growing. Here we see their total liabilities level currently at $24.7 billion as of fiscal year 2023, which is fairly high in relation to their annual AFFO at 8.9 times. Although this debt to AFFO level is actually normal for Realty Income, And over the past 10 years, their debt to AFFO has declined, beginning at 9.6 times AFFO. So by this metric, they're in a better financial position than they were at the end of 2014, although interest rates are higher than they were in 2014. The next metric we see is where Realty Income story becomes really interesting, which is the price to AFFO ratio, or PE ratio equivalent, which is currently near a 5-year low of 13.3, meaning over this period, Realty Income is rarely this valuable in terms of the amount of earnings, or AFFO, that you could purchase through buying a share. And better yet, their dividend yield is near a 5 and 10-year high, currently at 5.5%. This is actually a framework that I typically invest with, which is combining a PE ratio at a 5-year low coupled with a dividend at a 5-year high, which typically indicates mispricing by the market in my experience. And just to get a sense of value for the current dividend yield of 5.5%, the best high-yield bond ETF that I know of, ANGL, has a current yield just slightly higher than Realty Income at 6.3%. But the best part of Realty Income's high yield is that it's growing, with a 10-year dividend growth rate of 4.0%, a 5-year growth rate of 3.6%, and their TTM growth is a bit slow at a rate of just 2.4%. And their dividend appears safe if we consider their dividend growth streak of 29 years, or their amazing uninterrupted dividend streak without a reduction of 55 years. But dividend history doesn't give a clear picture of where a company is at currently, but their payout ratio does. Realty's current payout ratio based on AFFO is strong at just 75% of their trailing 12 months, and better still, their payout ratio has been declining since 2014, when it was at 85%. So I think Realty Income's dividend is safe and will likely continue to grow into the future, although slowly. Also, the platform I'm using, Simply Safe Dividends, rates Realty Income's dividend as safe at a score of 80, which is a fairly high bar for REITs in general. In summary of the fundamental analysis, Realty Income looks to be at a valuable buying point. Based on their price to AFFO, their historically high dividend yield, stable debt to AFFO, and growing fundamentals. And this investment is ideally suited for someone seeking income in an otherwise expensive and low-yielding market. Here we see a 5-year price chart for Realty Income, ticker symbol O. And the first aspect I want to note is the price trend, which is clearly down with a share price decline of 31% over this time frame. But the fundamentals over this same period on a per share basis have improved, which is my first indication of value. The next metric to interpret is the standard deviation channel, depicted by these 3 yellow channel lines, with this center yellow line indicating the average price over this period of $57.25, while the current price is only slightly below average at $57.09, not indicating a particularly valuable buying point. But what I draw from this is that O has been mispriced for years, and I think it makes sense to look at O over a 10-year time frame, which shows us that O trades in larger and longer cycles than many other companies. And based on the average price of $63.40 and a current price of $57.09, that is trading at a discount over not a 5-year period, but a 10-year period, at a current discount to the 10-year average of 10%. In terms of support and resistance, O looks to have respected and is holding this support level around $51, and it looks to be facing current resistance around $57, which it could break through or be rejected by. Lastly, graphed at the bottom of the chart, we have the Relative Strength Index, or RSI, which is a momentum indicator shown with this channel and white line. Based on this metric, O is slightly undervalued at a current RSI value of 48.7, while the middle point of this range is 50. So based on these 3 metrics, O looks to be undervalued on a 10-year time frame, and if nothing else, is certainly not overpriced or expensive, assuming their fundamentals remain intact and continue to grow. The one greater influence that I think could impact the price of O and create a more valuable buying point is if the S&P 500 reverses in the short term, bringing other markets and industries down with it. And I think it may do so in the not-so-distant future based on a few key fundamental and technical metrics, which I recently made a video about that you can watch here. That's all for today's video. Full disclosure, I'm long Realty Income, ticker symbol O.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.